These macroeconomic charts will blow your mind. First, let's start big picture, where we are in the great context of history. So this is the Federal Reserve's balance sheet as a percent of GDP. So whenever there is a massive shock to the system where the government just has to print out of control amounts of money, the balance sheet goes up. So you have World War I, you have the Great Depression, you have World War II, you have the global financial crisis in 2008, and then adding to that disaster, you have just absolutely phenomenal, unprecedented money printing in our history. You could argue this is how all great empires operate. There's massive shocks to the system and the currency gets debased. So the overarching big picture backdrop is that we have historic money printing, supply chain disruptions, geopolitical uncertainty, and absolutely skyrocketing energy costs. A very, very inflationary setup. And so they are doing everything they can to fight it. They are pumping interest rates. Here is the US 2-year Treasury yield spiking massively. The last time they tried to raise interest rates even anywhere near this high in 2018, they were forced to lower them. The market forced them to lower them. So blue is the federal funds rate. That's the Federal Reserve's interest rate. White is the 2-year Treasury yield, and they definitely track each other. So the Federal Reserve is pumping rates, and the market is making rates skyrocket. But again, it's hitting a ceiling. The last time we were at this level, they had to lower them, which you can see in the white line and the blue line back in 2019. And then we had a financial collapse in the pandemic, and so they had to bring them quickly down to the floor, and that caused markets to pump. So now we're in a different situation. So because they're raising interest rates, everything is falling apart before our very eyes. This is a slow-moving train wreck. So this is showing the historic bear market in bonds. People get all excited about stocks, but bonds are the big picture. They are much more important. There's way more money in bonds than stocks. We are seeing a historic sharp drawdown. So below, you are seeing a historic drawdown, 20% from its all-time high. And again, they only raised rates up to the 2018 levels, but it's causing absolute calamity. And this is going to ripple into everything. There are zombie companies out there. We know the US economy, the global economy is addicted to cheap money, low interest rates. We can't survive without it. We're a heroin addict. And when we lose that, we're going to go through a massive withdrawal. And so this shows actual S&P 500 earnings per share in light blue, mapped on top of Morgan Stanley's leading earnings indicator in the dotted yellow line. They track each other extremely well. So Morgan Stanley is seeing absolutely massive slowdown in the economy and in corporate earnings. We know this means disaster for the stock market. And so the yellow line is leading indicator, which means the blue line follows. And so expect a massive drawdown in earnings. We saw bonds collapsing. We're seeing interest rates spike, and we're seeing earnings collapse as well. And that is not all. We are seeing the housing market absolutely fall apart. U.S. new housing inventory leads U.S. unemployment. So first in the dark blue line, you can see historic housing inventories, which means there's too much supply, not enough demand, obviously, because mortgages are unaffordable now. And so what happens is when houses aren't getting sold, the U.S. unemployment rate in light blue skyrockets. And this is a rock solid correlation. So unfortunately, we're going to see, it seems like it, a massive spike in unemployment. You have bonds collapsing, you have stocks about to collapse, and you have the housing market collapsing, and that's going to mean unemployment. And so it seems like it's just a big disaster waiting to happen. Now, again, this is all by design. The Federal Reserve wants to slow the economy to kill the inflation that was caused by the money printing and the supply chain disruptions, the geopolitics. They want to suffocate inflation slowly by just slowing the economy so people stop spending money. Well, given all that underlying data in the charts I just showed you, people are about to stop spending money. We're entering for a very dire situation. Now, again, completely centrally planned and manipulated. So their hope is that we can just have an orderly decline. Inflation will slowly die so that when we do get this epic collapse in all things financial markets, the Federal Reserve could finally step in and say, you know what, maybe we won't hike rates. Maybe we'll be dovish. And we get that centrally planned bubble just continuing. And so even after all this chaos and destruction, that the Federal Reserve has caused in the financial market. Here's a look at the Federal Reserve's balance sheet. They're trying quantitative tightening. It's doubled. You can see that small little dip occurring. That is all they have managed to trim off this balance sheet. So they really want this balance sheet to come down. They want inflation to come down. And so the market's going to have to crash for a bit in order for them to be happy that they did enough. And it speaks to how deeply addicted to easy money our economy is, because the Federal Reserve's balance sheet has only rolled off that much, and it's causing this. So the big question is, will this plan work? Will they be able to have a soft landing? It all goes back to inflation. And unfortunately, the trend is not the friend of the Federal Reserve, because Russia just switched off Europe's main gas line because Europe sanctioned Russian fossil fuel exports. So now in white, you're seeing the Eurozone gas price benchmark just skyrocketing again. It had the brief fall because inventories were at adequate levels. Well, the Euro economy heading into winter can absolutely not sustain a shortfall in energy inventories. The Russians just shut off the valve, and so we're seeing a spike. Now, this is absolutely impactful to the world, to global inflation. And so the US is going to feel this as well, because we export a lot of energy over to Europe. And so that's going to keep prices higher here. And so there doesn't seem to be an end to the geopolitical mess, the energy crisis, very much like the 1970s, where oil was skyrocketing. There was very weak growth. That is called stagflation. And this is a picture-perfect example of what is going on. High inflation, terrible growth. The worst case scenario for the Federal Reserve. As long as inflation is sticky, it does not seem their plan is going to work. So because we're seeing spiking energy prices in Europe, we are seeing aluminum and zinc. This is just showing aluminum and zinc inventories in Europe tumbling, but all inventories are going to tumble, which is going to make everything more and more expensive. So yeah, they're entering a deflationary depression state because demand is being destroyed, because no one can afford anything with rising energy costs. But inventories are going to be at rock bottom. It's going to be expensive to rebuild these inventories. So that's probably going to cause even more inflationary shocks in the long term. And here's a chart which is very interesting. Russia is reporting a record current account surplus. They are getting filthy rich throughout all of this. They are incentivized to keep spiking the oil price for as long as possible. And that is exactly what they are doing. Sanctions are only backfiring on the European economy, it seems. So just an absolute mess. And this is going to trickle around the world in global inflation. So nothing is ideal in this situation. It's stagflationary to the core. So let's take a look back in time. When was the last time we had a situation as bad as this? It was the 1970s, like I said. So let's take a look at the chart of stocks in the 1970s. There was a massive run-up in the 1960s, boom times. Then we hit a stagflationary, inflationary wall. Stocks slowed, but you can just see the utter manipulation, just absolutely volatile, up, down, shorts getting squeezed. Very hard to make money on the long side. Actually, very hard to make money on the short side too, because of these massive spikes and squeezes we're seeing. So let's take a look at the current market. The S&P 500 looks practically identical. I can foresee a massively choppy period ahead, which is why my favorite investment strategy continues to be to have a short hedge, a decent sized short hedge in your portfolio, 2 to 5% on your entire portfolio, to ride out this volatility, raise some cash, but not lose exposure to your massively upside, exciting longs that are still in deep value territory. Don't want to lose exposure to that upside, especially in a centrally planned, manipulated economy where the Federal Reserve just has to say one word and markets will absolutely pump. And if you're a gold or silver investor, this chart is extremely exciting. In black, we're seeing the price of silver. In blue, we are seeing the net hedge position of commercial hedgers. And what it's showing is that since that blue line is above zero, they are long. Commercial hedgers are long. The smart money, the big money, is actually long silver for the first time. Looks like for the third time in its history. This comes from Sentiment Trader. Whenever it gets like this, there's profits to be made because this is the big money. These are the market manipulators that the silver and gold community always complain about. They are long for the first time, maybe setting up for a stagflationary squeeze in and panic-driven buying in precious metals. Who knows? I just wanted to paint a very clear picture about what is going on. Invest accordingly, stay hedged, and enjoy the ride. We will continue to stay on top of this market.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.